Inflation's low, central banks are dovish, maybe not so much. Where do you come down, and what does it mean for stocks?
Well, it means that there's certainly a lot of fear out there. I believe the 10-year Treasury is a very good gauge of fear, far better gauge than, for example, the VIX. So it suggests that there are concerns out there. But it doesn't necessarily mean that the market doesn't also see opportunities, because we've actually seen stocks hold up fairly well. So this could be an environment where, because yields are low, but there's enough confidence in the economy, at least right now, that we see investors stay invested, perhaps, though, moving to higher yielding parts of the risk spectrum, such as dividend paying stocks and perhaps emerging market debt.
Jim, as somebody who thinks about asset allocation, valuation of the market, obviously equities do have a valuation cushion if yields are low. But what does it mean for you in terms of where there is opportunity in stocks?
So we absolutely see the warning signs from the bond market, the gold market, even the stock market itself, sending certainly a cautionary flag up the pole. But we think there are select opportunities. Dividend growth stocks, absolutely, we would agree with that, especially dividend growers. We also like the beleaguered healthcare sector on a selective basis. And we've been shifting some assets from our large cap international stakes into the small, mid cap names in the foreign and emerging marketplaces that have a lot less issues and concerns relating to not just currency, but also to the tariff and trade concerns that continue to be the driver of the near-term marketplace. So long-term, we think this is the kind of market that creates opportunities. Near-term, we absolutely understand that it's the day-to-day event-driven news that's determining both the direction and the velocity and the volatility of the momentum.
Kristina, as Jim had pointed out, within equities, investors are certainly taking a defensive tilt by investing in utilities and REITs and those dividend-paying stocks. So when that new fear gauge that you labeled the 10-year yield, when that fear gauge drops, at what point do we stop thinking of it as a cushion for valuations and thinking of it as a signal that investors should take caution?
Well, it can be a signal that the economy is decelerating and decelerating significantly, but it doesn't necessarily mean investors should get out of stocks. That's because we're in a unique situation where we could see the economy decelerate because of tariffs, but because central banks have signaled that their willingness to be very accommodative, it could actually be a recipe for support for risk assets.
So even if we test 135, which is what a lot of fixed income folks say, which is the previous low on the 10-year yield, that would not signal to you that there's trouble ahead for stocks? You'd stick with it?
I think it would signal that there's trouble ahead for the economy, but we could be in a unique scenario where risk assets are supported because of central bank actions. This is the playbook from the global financial crisis.
Jim, thoughts on small cap stocks? I mean, the Russell 2000 continues to trade in correction territory. We've seen it underperform for months now. Why has that happened? Why would that not continue to happen? Because I know you mentioned that you were looking at some of those small and also mid-cap names right now.
Well, it certainly could continue to happen. I think the reason why it has been happening is that investors have been crowding trades right into the S&P 500 names and not looking beyond that pale. And as a result, many of the names in that pale look to me to be at fair or slightly overvalued, as opposed to names inside of the Russell 2000, where we know there's some selective good valuation opportunities. But in particular, we think that the long-term opportunities being built on the global market are in the foreign, international, small, and mid-cap space. I would say that when we look at this marketplace, we definitely think that now's a great time for investors to review not just their income needs and risk tolerance, but their long-term goals. Make sure they're aligned with what is likely to be an ongoing volatile marketplace, not just for the next couple of weeks or months, but well into 2020.
Kristina, I know you are also looking at some non-U.S. Asset classes that you think present an opportunity here that perhaps, represent what you said in terms of going elsewhere on the risk spectrum for some income.
Absolutely. Conventional wisdom has suggested that China will lose the trade war and the U.S. will win the trade war. I actually think both economies will be hurt, but ultimately the U.S. will blink first or the Fed will step in. In any event, I think Chinese stocks, particularly Chinese tech, has been beaten down. Fallen more than 30% last year, hardly seen much of a recovery this year. So that's an attractive opportunity as the market begins to expect that both economies are going to be hurt and essentially prices in more damage to U.S. stocks, less damage to Chinese stocks.